Hello, everyone, and welcome to the Sustainable Finance Podcast. My name is Paul Ellis, and I'm your host for these programs about developments in this fast-growing industry. As companies and investors continue to navigate the 3D reset themes of decarbonization, deglobalization, and demographic change, Schroders believes that it is important to consider the practical investment implications of these broad trends. In 2024, Schroders sees investors transitioning from simply thinking of ESG risk management and integration to an increasing focus on sustainable opportunities and themes to harness for value creation. While a main focus of sustainability is often climate, it is important that social themes not be overlooked, as there are many interesting ways that investors can use a range of social lens investments to pursue both alpha and positive societal outcomes. As many things in sustainability, definitions are important, and social lens in particular can mean many different things, depending on the stakeholders and the criteria being considered and the outcomes being targeted. This can include both more narrow social areas of focus or more broader ones, and we will discuss a range of these with our speakers today. Finally, social lens investing naturally offers opportunity for investors to align portfolios with certain values they hold, but can also allow them to pursue an investment case and return opportunities underpinned by fundamental trends. To shed more light on this rich and exciting investment area, we have three portfolio managers with us today. Chris Damm is an assistant portfolio manager on the U.S. multi-sector fixed income team at Schroders, working in a labor-focused investment style. Valerie Harrington is a fund manager at BlueOrchard, which is an impact investment manager owned by Schroders, working in a gender-focused investment style. And Uzo Ekwue is a fund manager on the global, thematic, and UK equity teams at Schroders, working in an investment style that considers structural drivers of broader social growth. Let's talk to each of them in turn and see why social lens investing is such a compelling category of sustainability. Chris is first up. Chris, your focus is around labor, or specifically investing in companies based on the quality of their labor practices, which is a more narrow or concise slice of social considerations. Can you tell us what initially drove the interest in focusing on labor practices within your investment process? And could you walk us through how you developed this labor-focused approach?
Sure. So hi, Paul. Thank you for having me on your podcast. So on the U.S. multi-sector fixed income desk, we manage about $27 billion across a variety of different strategies and client types. Our investment process integrates sustainable considerations, but we also manage a variety of more custom sustainable strategies from exclusionary to thematic. In the pension space, our client team has a strong relationship with the AFL-CIO and the North American Building Trades Union. Through their discussions, they found that there was a product gap in the Taft-Hartley space, where there were no fixed income solutions that align with the values of union members who are the beneficiaries of these plans. If you've ever spoken to a union member, you likely realize how proud they are of their affiliation with that organization. If you've ever looked at the website of a union, you'll likely see a list of companies that they either support or boycott based on the strengths of their labor practices. The underlying theme here is their pride of affiliating or not affiliating with these companies and the conscious decision of where to spend their hard-earned money. And we thought that this theme should translate to their investments as well. So over the past couple of years, we've worked together to develop a solution to fill this product gap, combining our value-oriented investment philosophy with a quantitative approach to assess the labor quality of corporate issuers in our investment universe. So in addition to delivering competitive returns, our goal is that when union members look at the underlying holdings in their fixed income portfolios, they should see companies that align with their values and support strong labor practices.
Chris, what specific metrics or indicators do you find most effective in measuring labor quality? And how does integrating labor practices into your analysis impact the structure and the composition of an investment portfolio?
So through our discussions with the AFL-CIO, we familiarized ourselves with their core values. So their core values include labor law, pay and benefits, workplace health and safety, global workers' rights, and equality. And our goal was to use these themes or as the basis for our labor assessment. So to do this, we built a quantitative approach that ranks issuers within their peer groups based on roughly 15 different metrics that align with these main themes. And we call this our labor model, this quantitative approach. And through our model, we believe that we can generate a solid assessment of an issuer's labor practices by combining these data points into an overall score for an issuer and ranking those against its peer group. So to tie this all together, on the next slide, we have an example of the utility company Enel. So relative to utility issuers, we have found that Enel has best-in-class labor practices. This assessment is based off of factors such as the policies that they have in place to protect and develop their employees, their time spent training their employees, pay equality, and less employee and contractor injuries relative to their peer group. So how do we integrate this into our portfolio? So we implement the labor quality into our investment process, combined with a fundamental credit analysis and a value orientation to produce an investable universe of companies that align with our objective. Because our labor assessment ranks issuers against their peers, we are able to utilize this approach without diverging from our existing sector allocation. So if you look at the corporate allocation of a portfolio with a labor-aware approach and one without, and compare the two, you'll likely notice a similar sector allocation amongst the corporates. But to dig it a little deeper, in the portfolio that has a labor-aware approach, you'll likely see a tilt towards companies with strong labor practices, such as those who invest in their employees to train and develop them, those who instill a culture of workplace health and safety, those who embrace diversity, and those that have lower turnover, all relative to their peers.
Okay, now, Chris, what role does engagement play in your overall assessment of labor quality?
So the labor model and our analysts' assessment help us quantify and assess the labor practices of issuers, but engagement really helps us understand the broader picture. So we engage to fact find, such as companies that have poor disclosure of the labor metrics that we look at in our model. And we also engage to encourage change, such as companies who our model and analysts deem to be lagging in labor practices. One example of an engagement with a labor focus is McDonald's. McDonald's has recently encountered allegations of practices which infringe on workers' rights and the health and safety of their employees. Among social issues, our analysts identified them as a laggard given these issues, and our labor model had a similar assessment. So through the engagement, one of our team's findings was that McDonald's had recently revised their standards to address these issues and has built out guidelines regarding the protection of their employees. While these were steps in the right direction, our team determined that more could be done to protect employees and use the engagement as an opportunity to discuss and promote best practices with the company's executives. Overall, the engagement helped improve the clarity of our opinion of the company's labor practices and reinforce the negative score output from our model and our analyst assessment.
All right, Chris, well, finally, what are some of the broader implications of investing in companies based on the quality of their labor practices?
Human capital factors such as workforce demographics, employee turnover, and human resource policies can have a significant impact on a company's financial performance and creditworthiness. Research shows that companies who invest in their employees and cultivate a happy and collaborative workplace can outperform companies that don't. On the other hand, companies with poor labor practices can be exposed to material issues, such as higher costs due to employee turnover, litigation costs from workplace incidents, lost revenue due to work stoppages, or loss of productivity from their employees. So we believe that incorporating these factors into the investment process of an actively managed fixed income portfolio can provide valuable insights that can mitigate downside risk and help generate alpha opportunities.
All right. Well, Chris, thank you very much for your time today. We appreciate your participation in the episode. And next up is Valerie. Valerie, you represent an impact investment manager, which is a distinct category of investment approach, and you focus on gender lens. So obviously something much broader in nature in terms of trying in a variety of ways to unlock the unrealized economic potential through enhanced financial inclusion of women in the economy. Please tell us, how do you define and practice impact investing at Blue Orchard?
Thank you very much, Paul. Happy to be here. Maybe I should start with a very brief introduction on Blue Orchard in case some of the viewers are not familiar with it. So
yes, please
as
do.
you mentioned, we're an investment impact manager, and we focus on emerging and frontier markets. And we've been part of the Schroders Group since 2019, but we were actually founded back in 2001. And so since then, we have dispersed more than 11 billion in emerging markets across more than 100 countries and have reached more than 300 million people. Historically, we've been, let's say, private debt focused, as well as financial inclusion in terms of impact intent. But now we have also grown into other type of asset classes, such as private equity, public debt, and as well branched out on many other impact topics. To go into really, yes, how are we, let's say, a bit different from other practices that there are at Schroders, being an impact investor, right? Because impact investing is very specific in terms of the intent and the measurement of the investments, right? In order to evidence the impact that we're having. And so, as I mentioned, topics with regards to impact intent can include financial inclusion, female financial empowerment, climate change mitigation, adaptation, education, etc. And so we do all of this through our Be Impact framework, which is a bespoke impact framework that we've created at Blue Orchard that is then obviously adapted to the objectives that we may have with our different investment strategies. Here you can see the three main pillars, which are, of course, the ESG pillar, which remains very important in impact investing, in which we look into the environmental, social, and governance aspects of each of the institutions that we may invest in. But a very critical pillar is the impact pillar. And here you can see that, the intent plays a key role. What is the intent that we're trying to achieve with our investment? There's a lot of focus on KPIs and on tracking that. It is important to predetermine who are the end beneficiaries that we're trying to impact, as well as the contribution that we want to have with an investor, as an investor, and the risks, in particular impact risks that this investment could have. And then as well, the third pillar being the SDG mapping and alignment, which of course is very important for industry standardization. And as you can see at the bottom of the slide, this is aligned with a lot of the different industry leading, let's say, best market practices. In the next slide, you can see some information on the verification. And so I think this is to show that when at Schroders and Blue Orchard, we talk about impact investing, we truly mean it and we take it seriously. And so, as I mentioned, this joint impact model, Global Impact Investing Institute, as well, of course, the operating principles for impact management. There are, from these entities as well, even from a regulatory perspective, a very high bar with regards to what impact investing is. And I think it's important for investors to know that this high bar is attainable and is being met by different players in the market. And so that's what should be required by investors coming into impact investing. And I think another important part, of course, of impact investing is the investing part, right? Meaning that it's also good business for investors as well, right? Impact investing doesn't mean concessional returns, right? There are many players in the market, including Blue Orchard, that seek to invest at market rates. And so this really enables investors to productively put money to work aligned with their values.
Okay, so we've been talking just briefly here about the investment case for impact investment strategies. Why does this make sense for investors? You've said a little bit about it, but could you expand on that just a bit?
Definitely. So in the next slide, I can cover this. And so, yes, in BlueOrchard in particular, we have a strong track record in microfinance in emerging markets. So happy to cover that as the answer, right? And so microfinance would be a subcategory of impact investments, right? And so for an investment case for microfinance, of course, the mega trends in emerging markets play a relevant role, right? As you mentioned, demographics, this population growth, this emergence of the middle class, that from an economic standpoint and from an investment perspective makes sense, but as well from an impact perspective, right? Because by addressing this, gender disparities, ensuring equal participation for all members of society, there is also an impact opportunity. Same with other mega trends such as decarbonization, right? In which through this investment opportunity that this poses, there's also the opportunity to build resilience of more vulnerable populations in emerging markets that we know will be the ones most affected by climate change, as well as digitalization as well, for example, as another important megatrend. So that on the emerging market side, and now on the microfinance side specifically, microfinance has been around now for more than 2 decades, and so they have been accessible for investors with the purpose of achieving both an attractive risk-adjusted return as well as positive impact in emerging markets. And so over this time and with the track record that has built, it has gained recognition as an asset class that has several benefits. So as you can see in the slides, microfinance shows low correlation with wider markets, low volatility, as well as protection against inflation. And so this combination of factors actually also makes it an appealing choice for investors seeking to diversify their portfolio, and so a good addition to the portfolios overall.
Okay, now how does one go about investing with a social lens, in particular, the gender lens for financial inclusion that you focus on? And why is this particular approach so impactful?
Yes, maybe on the next slide, we can use Latin America as an example. So here you can see some scary, worrying statistics. So for example, there's more than 93 billion credit gap for women, small and medium enterprises in the region only, which this basically means that the majority, up to 70% of the women-owned small and medium enterprises in the region are either unserved or underserved financially. And so even when these women entrepreneurs do get access to financing, the average loan sizes that these businesses get are 2.5 times lower than their male counterparts. And so, of course, in a region like Latin America, this is even more amplified for other, let's say, cross-sectionality topics such as indigenous populations and Afro-descendant women, right? This topic gets further amplified. And so there is, from an impact perspective, a problem. And as an impact investor with experience in the region of Latin America, we would then go and try to contribute to the solution. And so on the next slide, we show a bit of the microfinance value chain. And so seeing these problems, combining it with our experience in emerging markets, one action that could be taken would be investing in financial inclusion. And so an efficient way of doing that is providing loans to financial institutions or microfinance institutions that can then on-lend to end borrowers. And so if we were to do this with a gender impact intent, we would focus on microfinance institutions that already have or that are willing to develop specific products or services for women. So, taking into account their special needs as customers, as entrepreneurs. And so, in the left side of the slide, I think it's relevant as well, and being part of the blended finance team, right? If we were to action on this, we would probably use blended finance, given that this is a very specific impact intent as well as a geographic focus in Latin America. And so in order to make it work for private investors, we would leverage a partnership with the public sector. And so why? Because public investors are willing to take the highest layer of risks within these types of structures, and so they leave the private sector in a privileged situation, because ultimately what the development sector wants is to bring private sector to the table. In the next slide, more in detail on the gender, right? Given that this would be, we talk about gender lens investing, the strategy would develop a specific theory of change, right? Such as the one that you see here, in which we identify the gaps, right? So the gender financing gap, as I mentioned, the labor exclusion of women in the economy, as well as the disproportionate poverty of women and other underserved groups. And, as impact investors, we would analyze what are the inputs and the activities that we could do to generate specific outcomes and ultimately impacts, right? And in this scope, the impact, let's say 3 pillars that we would deem relevant are, improved access to financial products and services that are tailored for the needs of these women and underserved groups, as well as leading to increased resilience of these women and diversity and inclusion at the financial level, right? Because microfinance institutions and financial institutions in Latin America are an important, robust part of the economies, and as employers, if we make them or push them to be more diverse and inclusive themselves, that of course has positive repercussions in their workforce.
Okay, well, thank you very much for those examples, Valerie. That clarified for me anyway a whole area of investment for impact that can be more effectively approached when companies like BlueOrchard get involved. And thank you very much for your participation today. Finally, Uzo, your investment approach is by far the broadest in scope that we're talking about today. So tell us, how do you approach investing in social from a public equity perspective?
Hi, Paul. Thank you very much for having me today. So, whilst concessionary, mission-driven, and impact investing are really important, sometimes this can often mean giving up financial returns. But this is not our approach, because we're really squarely focused on generating alpha. And so how do we do this? Well, we do this by investing in the growth opportunities that are driven by the secular trends that are shaping society around us. So we're really using the principles of growth investing, but harnessing what we do to invest in global companies whose products and services are making a real positive contribution to society.
Okay. What are some of the secular trends that you've mentioned?
So one of the first secular trends is changing demographics, and I'll just touch upon some of these. One demographic trend is aging populations. So if we go back to the late 1950s, the average person born at that time was really expected to live until about 50, and you can see that in the dark blue line on the left-hand side. But meanwhile, somebody born today, on average, will live until about 75, and we expect this to rise going further. And then when people are reaching 60, they can expect to live a lot longer than they did in the 1950s, and that's because of things such as better medical advancements, improved diets, and improved access to healthcare. Now, if we look at the second chart, so the shaded blue area that we see there, that's really the range between developed regions, so the light blue line, and less developed regions, and that's the purple line. And we can see that the gap between the two has narrowed over time, and that's been driven by fertility rates in less developed regions declining over the last 10 years or so. And look, we think that's a good thing. It's to be celebrated, because it reflects better social security in less developed markets for people approaching retirement, as well as a less reliance on their children to support them in old age. And then we've seen that for quite some time, the fertility rate in developed markets has been below that 2.1 threshold set by the replacement rate. So that's the green line there. And that's defined as the rate that is required to maintain growth in the natural population. So in other words, we're seeing a decline in the natural population in a lot of developed economies. And as a result of this, we're left with an aging population. Another demographic change that I can talk about that is a real long-term driver of societal development is the growth of the middle class. So we know that the world's middle class is already the largest spending group, and they're responsible for more than 2/3 of spending. And that's driving increased consumption of goods and materials. And over the next 7 years, we expect this to grow furthermore. And we see that on the bottom left. And as people and economies get richer and wealthier, we expect them to be able to afford better quality education, for the demand on the food system to increase as they consume more, and for them to also be able to access healthcare better, thus leading longer lives. Then as more people move out of poverty, more than half of the world's population is projected to be in the middle class by 2030. And this is really going to have a significant impact on the way our cities are going to look. So on the right-hand side of this page, we can see that by 2030, the number of megacities, so cities with a population of more than 10 million people, will be more than 4 times what it was in 1990, and that's owing to the growth of the middle class. So the next secular tailwind that's driving societal development is deglobalization. Now, this is not a new word. Brexit was an example of deglobalization, as was the appointment of Trump. But more recently, deglobalization has been accelerated by the pandemic. If we cast our minds back, we saw massive disruption to supply chains. You know, people couldn't go out, they received government subsidies and checks from their employers. So what do they do with that? They bought more goods. And that created a huge demand shock. But then on the supply side, you also had a lot of factories being shut down. And companies that had typically sold for Far East low-cost manufacturing were now instead reappraising the locations of their manufacturing capacity and prioritizing resilience and security over cost. So on the left-hand side of this page, we see that the number of US companies mentioning reshoring in the earnings transcript has actually exploded versus pre-pandemic. But it's not just them saying they're going to do it, they actually are doing it. And we see that on the right-hand side. And that's been helped by things such as the Inflation Reduction Act in the US and the CHIPS Act. The final secular trend is technological innovation. So I probably don't have to convince you and your listeners that technological innovations play an increasingly prominent role in the growth of leading industrial economies. And as a result of that, governments have been shifting their attention from science and technology policy to focus on research and innovation policy. And we can see this on the right-hand side, where R&D as a percentage of GDP has been rising, whilst the number of global patents has also been increasing as well. By the end of this decade, the working age population of the world's largest economies will be shrinking. And that's because of the aging populations and the falling fertility rates that we talked about earlier. So whilst education will help to drive the reskilling and upskilling that will be needed as a consequence of the new jobs that will be created from nearshoring or reshoring, there will also be a trade-off in terms of, trade-off between employment and the use of technology. And that will be most particularly in blue-collar occupations. And in fact, we're actually seeing that the installations of robots has been increasing, and we expect this to continue to rise. So that's the left-hand side chart. But when we look at the chart on the right, the number of notable machine learning models has actually increased over the last 20 years. And we also see here that artificial intelligence has gone from concept within academia to practical applications within corporates themselves. And that's going to play a really big role in terms of helping with the demands that will be placed on the working population.
Now, Uzo, how do you as a portfolio manager implement these long-term secular drivers from an investment perspective? And are there particular thematic areas that you're focusing on right now?
So there are 4 different buckets that I think are really exciting and that are well poised to benefit from these secular trends. And that's because there's a significant amount of investment required that will drive earnings growth, which we don't believe that the market is pricing in. So the first one on this slide is health and wellness. We know that an aging population and increased chronic conditions will put upward pressure, which is a continued upward pressure on public health costs. But the current level of government spending is insufficient to meet today's healthcare needs. And that's why personal spending or out-of-pocket spending is filling the gap. But high levels of out-of-pocket spending can also affect access to healthcare. And then on the wellness side, this is a really exciting $5.6 trillion market globally that is expected to grow at a compound annual growth rate of about 8.6% between 2022 and 2027. And that's well in excess of GDP. So overall, I do see opportunities to invest in areas like cell and gene therapy, traditional drug development as well, biosensors for things like monitoring your glucose levels, health insurance, fitness, robotics, and so on and so forth. The second theme on this page, and that I think is really interesting as well, is resource security. And by this, we mean food security and energy security. In relation to energy security, we know that energy usage is fundamental to both economic output per capita and economic growth per capita. So essentially, the wealthier or richer a country is, the more likely it will use or has used energy resources in order to get there. So economies that rely on energy supplies to run their industries and provide essential public services, thus driving societal development. So therefore, it would then follow that any shortfalls of energy due to a lack of affordability or availability will risk energy security and will be a significant concern for societies, particularly those that are manufacturing or export dependent. And so look, various opportunities are in energy security. There will be in areas such as sustainable fuels, renewable power generation, and so on and so forth. Then food security, as I mentioned, or food insecurity is a global problem and most significant in emerging markets, as we can imagine. So again, as countries become wealthier, people can afford to eat more food, and we typically see that their calorific intake increases, and therefore also we see demand for protein also rises as well. And opportunities on the food side are across the supply chain, so from agricultural inputs to processing, distribution, and retail. And the third theme that I quite like on this page is essential infrastructure. And the need for this is going to be driven by the emerging middle class that we talked about before, which will in turn fuel urbanization. And I also mentioned deglobalization before as well. So this will unquestionably lead to increased local manufacturing and infrastructure development. So areas such as hospitals, transportation, housing, and so on are all forms of essential infrastructure that we need in order to support society. And then finally, the last theme, last but not least, that we think that will be a catalyst for societal growth is educational, professional, and financial inclusion. Primary and secondary education are important, as is tertiary education. And we see that higher education participation is really uneven across the world, and that presents a real opportunity for investment. Then also we see that more retirees are going to place a greater burden on the workforce, and the aging population is going to put a strain, not just on government budgets, but on workers as well. So therefore, there's a real opportunity here to invest in companies that focus on optimizing the productivity of the working population. So for example, through job growth, reskilling, upskilling, and through the use of technology. And then lastly, with financial inclusion, access to financial services is critical to support social and economic well-being, especially in cash-based economies, which tend to be in developing markets. So across that overall inclusion space that I just talked about, we see opportunities to invest in things such as recruiters, job platforms, digital and online learning companies, payment companies, banks, microfinance, and so on and so forth.
Now, Uzo, how do you put all of this together in an investment process? And from that point of view, how does that work in portfolio management?
So in constructing the universe, we built a proprietary screening tool to identify those companies whose products and services are positively contributing to society. And this screener has two inputs fed into it. The first is Thematic, which is owned by Schroders. And that tells us the revenue alignment that a company has to one or more of the United Nations Social Sustainable Development Goals. The other input is called Sustainx, and that's also owned by Schroders. And this is designed to quantify the positive contributions and negative impacts that companies have on society. It tells us what a company's social value as a percentage of sales is. So, for example, if a company had a score of plus 5%, it means that for every $100 of sales the company is making, it is generating an overall positive impact on society equivalent to about $5. So it really is groundbreaking and superb for what we're doing and what we're trying to achieve. So on the left-hand side of this page, if we start off with a very broad global universe of just under 14,000 stocks, we then use that proprietary tool to specifically filter for companies involved in social themes such as education or healthcare, whilst at the same time we're also deselecting companies exposed to things such as predatory lending, so things that we don't want. And this gets us to a broad social growth universe of about 7,200 stocks. We then run our pure play thematic screen. So essentially we're finding companies that have at least 50% of their revenues aligned to one of the social UN SDGs and that have a positive social Sustainx score. And in doing this, we get to a global social growth universe of about 4,000 stocks. So this systematic screen really helps us to identify what we would call as social leaders. But then if you think about it, investing in the leaders of tomorrow will mean that there will be companies that today are falling short of the bar that we've set. And we call these improvers. And so we add some of these manually to the systematic filter, and we then apply an investability filter overall. So things such as market cap and liquidity. And we do that to the overall screen to get a final global social growth focus list of about 600 stocks. So I do want to make it clear that we have a very transparent and clear process in place for these manual additions. And it's from these 600 stocks that we build ultimately a 40 to 60 stock portfolio. Now, if we move on to the chart in the middle, of course, we analyze and value these companies. And how do we do that? Well, our primary tool is that we conduct really detailed financial analysis using financial models, and we use a 20-year DCF to determine the value of these companies. Why do we use 20 years? We think it's really important because we want to capture the very long-term growth opportunity that's underpinned by the secular growth trends that we talked about earlier. And then we complement the DCF with additional analysis to understand the nearer term compounding ability of a stock that isn't often captured in a DCF. Then we have a sustainability overlay, and that captures 6 ESG and stakeholder management categories. So areas such as employee engagement, supply chain management, and regulatory management as well. And we put a score against each of these categories, and we use it as a point of engagement with our companies, just to make sure that they are on the right track and that we can measure and monitor them throughout time. And then on the last chart on the right, we blend all of this together when managing the portfolio, whilst also blending things such as stewardship, voting, and reporting as well. So in conclusion, what we're delivering and the way in which our approach is an unconstrained, diversified, multi-thematic strategy with global reach. And by being multi-thematic, we can provide diversified exposure to various themes and sectors, therefore helping to reduce overall volatility in comparison to what you might see sometimes in single-themed strategies.
Okay, well, thank you very much for that explanation. That's a lot of information for our listeners to absorb, for me to absorb, and we will we'll be working on that as we review the program. I want to tell all of our followers of the Sustainable Finance Podcast that you can learn more about the opportunities being explored in 2024 by the Schroders and Blue Orchard teams on the firm's website. And you can also write into the Sustainable Finance Podcast with any questions that you have about the topics that we've discussed in today's podcast conversations. We'll put those followers together in contact with Schroders and Blue Orchard as appropriate. I want to thank very much Chris, Valerie, and Uzo from Schroders and Blue Orchard for joining me on today's episode. And our followers can stay tuned for future conversations with the Schroders Sustainable Investment Team in 2024 and beyond. I'm Paul Ellis, and this is the Sustainable Finance Podcast.